All right, what's going on, everybody? So, market seems like it wants to just hang out. No real big gotcha moments. Whatever they're waiting on, we're still waiting on it. It's interesting, though, that we didn't see uh, any sort of hedging or anything into today, which already kind of gave us the impression that there wasn't anything to be concerned with, or they would have hedged into it, right, from the get go. Sorry, just answering questions to someone who's in the support channel. I can't type and talk. I can't chew bubble gum and walk. Those sort of things. All right, so we had some recommendations for topics. Always love it when you guys have something that you want to cover. So Tomex, I can see that you're in the chat, in the stream, which is great because I don't have to sit there and keep trying to type at you. There are no channels other than the main chat when it comes to trade. And the things that you're talking about is role permissions, right? So with role permissions, some people don't want options alerts, right? Or swing trade alerts. So they don't push that button and then they don't get the alerts. If I want to at here and I do that, everybody gets a ping when I do that. They probably don't like it when I did that. And if I do at swing, then only somebody who's subscribed to that role will get notified if I do that, right? Or futures, then it'll be for the people who signed up to get alerts when we post something for futures. It's just a role setting for alert processes. That's it. If you don't want an alert as a swing trader, if you don't want an alert for a futures post, then don't click on that. And then you won't be notified if there is a post for swing traders or for futures traders, right? That's all that it is. That way, in the trade rooms, I think that's what we're talking about here, right? Swing options and futures, it's just notification. See how it says right here? Select what you want to be notified. Just hit the button below. It is a notifications process. That's it. Cool, cool. I know if you're new to Discord, it's all something that you have to get familiar with. I get it, but you're not missing anything. We don't run live streams 24 hours a day. We don't call out trades every single day. When we do call out a trade, if you clicked that button, you will be notified when we alert you with whatever it happens to be, swing or futures or options. I thought there was a chart request. Did I miss it? Someone wanted to look at, what was it, PLTR? Yeah. Where'd your post go? Oh, dude, it's right there. Never mind. It's just one of those days. I see it. All right, so PLTR. This is an unusual one. And it's why we often say, know what you're trading, right? So stocks generally don't do what this did, where it goes from $5 to $190 with no real pullback, especially in a 2 year period of time. I mean, look at how many red candles we had for just this year. Two, if we don't count the currently open candle, two red candles on that monthly chart. So this is a very unusual stock, and that means you don't want to treat it like everything else. It's getting a pretty good size pullback. I've already seen a lot of people who say, "Oh, I'm going to short the hell out of this." Okay, you do you, but shorting it hasn't been a really good play so far, not in the last 2 years, right? So you can get some short-term trades on this to the downside, but other than those short-term trades, this thing has just been a beast. Now, after the last earnings, not this one, the one back here, we finally stalled out and we went sideways for an entire quarter. If you look at that, right? The whole quarter, we just digested that previous earnings. But we did the same thing back here, right? So are we going to ramp like that for this next earnings? I mean, I don't know, right? I lost my crystal ball, but I wouldn't short this. Now, here's a couple of things to take into consideration when it comes to swing trades. It's a bad bet to short all-time highs, and it's a bad bet to buy new lows, right? In general. And we're talking like swing trade stuff, right? If you're day trading, sure, why not? Grab new lows and try to run reversals and try to short new highs. Because look, I mean, if you had shorted that as a day trader or intraday trader, you'd have made some money. So know what you're trading. If a stock is behaving unusually, try to spot that. Go to the daily, the weekly, the monthly, see if there's any behavior that stands out. These guys got a lot of government contracts. They've got a lot going for it. Their earnings had a lot to offer, and I don't think it's done. The thing about Palantir, from memory, and it's been a couple of days, right? I think their earnings were good. It just wasn't good enough. So it wasn't like they had a bad earnings. They just didn't have earnings that met the lofty expectations of the people that smashed it to the downside. So where do we go from here? At that point, we can treat it like anything else, right? If we treat it like anything else, then we've got levels that we can play. If it stays above the 786, we can look for it to digest, hold the range, and maybe even continue back to the upside. If it cuts 786, we can run it to the half, and under the half, we can run it to the bottom. Now, we've already made some good moves to the downside that got bought right back up again. And today, for an example, we're back above the midpoint. So being back above the midpoint doesn't necessarily mean we want to go long, but it's hard to see a short here. You could wait for price to actually give you some sort of tradable signal. Right now, we've got these lower highs and lower lows. So you could look to see if we're going to base here and maybe start moving up, get some candles that break that high, give us a higher high and then a higher low, and then break this high, get a higher high and maybe another higher low. Until we have that, you look at it and you say, well, what do you got? Uh, Bias It's been a really strong stock. I think it's going to continue to go higher, and so I want to buy into it. Okay, I get that. You don't have a signal. Don't have any bullish processes that say we should get into it because of blah blah blah, right? So one of the things that I like to do before I get into a stock or get into a new trade is ask, what's the market backdrop like? I'm looking for any reason to not take a trade. Cypher's amazing this year. Cypher is tied into the data centers and all that stuff, right? These guys are the linchpin or the key to all of it. So you take a look at the broader market and say, is this a good time to be getting into stocks? No. If it's not, then I don't go put on new swing trades. I'll take day trades. I'll take short duration swing trades, like I'm going to get in today and get out next Friday. I'll take those kind of swing trades. But I'm not going to look for anything, 3 to 6 months, run it to the next quarter, add to my long term buy and hold account because it's a bad market environment. I'm a risk averse person, right? So if we're just looking for short term trades, then that's awesome. You've got a fantastic opportunity to treat your day trades and your swing trades the exact same way. So what do you need? Inside day breakout, a bounce off the mid, a bounce off of the low. Any of those would be a tradable opportunity, right? You can now treat your swing trade just like you treat anything else because it's just a short-term swing trade. You're not looking for a long-term trade. In which case, short interest and all of these things that's on this list, none of that would matter a lick. It doesn't matter because it's a short-term trade. If it's a long-term trade, then I'm going to pay attention to the monthly, weekly, daily pivots, moving averages, anchored VWAP, support and resistance, price patterns, narratives, unusual options activity. I'll look at all that stuff for a longer term trade. 225. We'll talk about unrealistic expectations. What do we need for this stock to hit 225? You got to completely reverse all of the negativity that you've already got and then break out of the previous month's range to the upside. At least we're back above last month's mid. We can at least say that. We got the gap closed and we managed to get back above it. So get out of this gap, right? We got to get out of this channel that we're in here. Get back above that and then work on last week's range. Get through the mid of that to get to last week's high, break that, and then get through our own high of this week. Notice that this week was a gap up and a drop. That's a gap and crap. Uh, that's the technical term, right? Fake break fast failure. They call it that one too. Gap exhaustion. So this is a bearish short-term signal, right? Not a big long-term signal, but when you see a gap and crash like this, it's not good. Trying to go long into 225, which is completely unrealistic for a short-term trade. Hopefully, you didn't do it with options, right? Hopefully, you did it with stock so that you can take your time and there's no rush. And if it gets there in 2 months, what do you care, right? You're not burning theta decay. But if you bought some calls or something like that, I hope you got time on those calls or that it's really cheap, right? Because if it's really cheap, who cares? That's the best part about a lotto trade. You get it, and you're risking 20 cents. And you're like, whatever. I spend more than that on a tip at the restaurant. No big deal. So you're going to need a little bit of time, very likely, just to get back up through all of that trash. So when I'm looking for a trade, just like with any other thing we're doing, if the market backdrop is good, then I focus on trades. You know, but if we've got government shutdown, a change in the FOMC structure, QRA coming up, a big rotation between bonds and yields, I'm not looking to add to my big account, my long-term account, because there's a sea change going on, right? Something is really altering the landscape, and there's a lot of risk, and I don't want to add to new positions for big long-term stuff. If we're not in that situation, then I'll start to look at things like the monthly pivot, weekly pivot, daily pivot. Let's start with those. So I know pivots get a bad rap, or everybody thinks they're complicated. But if you draw a line at last week's high, that's a pivot. It's a known pivot. Open, high, low, close. Those are all pivots. And we don't have to call them pivots. We can call them levels, lines, but generally speaking, they're a pivot. On the time frame that you're looking at, they will form support and resistance levels. So if you're on a monthly and you mark last month's high, that is now a resistance level. And if you think about it, that makes perfect sense. In the last month, we got to a level that those monthly traders weren't able to get through. We stalled there and we fell back down. And if we look at it on any time frame lower than that monthly level, we will see the same thing. The weekly got there, or the daily got there, the hourly, whatever time frame it was when we got to that spot, we weren't able to make it through there. I wouldn't change anything just because I think 225 is an unrealistic number doesn't mean that I'm right. And if the risk is low, it doesn't matter anyways, right? We got to get through the midpoint of our own current week before we can do anything else. And I'm ecstatic because we were actually able to get back inside of last week's range. That's a really good start right there. Just getting this gap closed and then getting back inside of last week's range. That was a lot of work right there. And it shows that you're not crazy, right? If you were wrong and we were just going to keep falling, we would not have gotten back up through this gap close, and we wouldn't have gotten back inside of last week's range, right? I like to see the market tell me I'm right and give me little signals. It encourages me to stay in longer. It encourages me to, hold my position and not puke it out. So these are good signals. You don't want things telling you that you're wrong, right? So that's a good thing. The problem is we've got these really big gaps here on the daily, right? And on the daily, We can see these loops. That's what I like to call them, where we bid down and we bid back up. This one is kind of inconclusive because everything's around the middle. Today's, it's back up near its highs, and that's a good thing, right? We don't want it closing below the half. We don't want it, down here near the end of the day. We want it above the midpoint, and we're inside of yesterday's price action. So that's good. It does look like we rejected yesterday's midpoint, and that's not good, but we're not done yet, right? So, it tried to get through the mid, it failed, but we're still in this lower portion. And as long as we're inside this candle, then it shows the strength of this, that it rallied back up and got back in that box. So that's a good thing. I would want to see this continue to prove me right. Now, we gapped down from the earnings, and that right now gives us the start of an island. The problem is we don't know if it's actually going to be an island or not, right? So if it stays down here and it builds another candle and another candle and then another candle and then it gaps all the way up here, then we'll call that an island reversal and it'll be bullish. If we build some candles down here and then we run up here in one single candle, that won't be an island reversal anymore. It'll just be a gap close. And that, again, I mean, that's not bad. It's going in the direction you want it to go, right? We're just talking about what would I call it? That would just be a gap close because, we closed here and we opened up down here and we just went back up there and got the gap closed. This gap close is going to be the most difficult level to get through out of all of them. So if we can get through that level and close above it, then your 225 is more viable at that point. Right now, I can't see that it's viable because we don't even know if we're going to make it to that close, let alone get through that close, right? So don't shorten your price target until we at least get through that and see how did we get through it? Did we make it in one day? Did we get there and have to fight through it, for half of the life of your options trade? And that'll give you a better gauge on, is this a trade that I should still keep? What's your risk management in this trade? You got a stop or a line in the sand, a plan to use alternate options trades? Today's candle is a stop or just an alert? Right on. I get that. Um, I've never been a big fan of stops other than on my futures, because the losses of futures can get so bad so fast that they're just really bad. And on things like SPX options, because they're thousands of dollars and they have the fastest rate of change of any option I've ever seen. So I use stops on those if I need to. But if I'm doing a vertical or butterflies, iron condors, that sort of stuff, I don't generally use a stop. Now, this is not about right or wrong, and you have to sleep at night, right? So, you know, don't don't think that what I'm saying is the right way to do it or the wrong way to do it. I don't like having a hard stop. on a spread trade, especially if I sold to open the trade. Now you're in a long call vertical, so that doesn't fit what we're talking about, right? If you had sold puts, then that would be completely different, right? A long vertical, having a stop isn't as bad. The reason I don't like having a stop on those, though, is because the options price can move even if the stock's price didn't, right? So we can stay in this range and they could come out with news tomorrow or news in the overnight that drops the price to, say, the middle of today's candle. And yet the volatility would spike or the volatility would get sucked out of it. And the options value itself would radically change and you get stopped out of a trade. If you set an alert at yesterday's low or today's low and you say, this is my line in the sand, if it gets there, I'm going to go in and look at the trade and I'm probably going to manually close it. Well, that would make sense because that's where you want it to be, is your exit is if price gets lower than today's low, you're going to get out. But I like to manually do it. How did we get there, right? I want to evaluate, how did price get to that low? Was it a headline news and we're already on our way back up? Did we grind down there and we've got more orders coming in and lots of options are being traded to short this company and it looks like we're going lower? Well, then heck yeah, I want to get out. Yeah, and that's good too, that you have a plan for what you expect. That's really good because that's the key to the whole thing. So you're thinking it's going to do one of these and then it pops back up the other way, not stall here like this one did, but the reversal candle that closed at the high of that reversal, and then the follow through right on up. Yep, I got you. This, if that's all I had at the time, that's a really good signal. At the bottom of a run, huge dump, big reversal, and it ran up and it closed at the high. That's a beautiful setup. It didn't follow through this time, but I don't care. Like you can't find good ones every time, but that's a really good one to spot right there. I love those, especially in the afternoon, 2:30 in the afternoon. If I'm flipping through the charts and I see that, I really like it. So, pivot points. If I'm looking at a chart, I want to see, hey, do we have a pivot point? So, um, Palantir, it is unusual. It's very bullish stock. It's been bullish for 2 years. I don't think it's done yet. It didn't please investors, but it didn't have a bad earnings. I think it's fine. If I was looking at something like JOBY, right? And I had someone ask me about this one, would I trade it? Well, I mean, yeah, I wouldn't mind running it back down if it broke this low and maybe get into 13 and a half or $13. All we've got to do is break that low, and we can snap something like a fib on it to see the 111 or the 1236 and get that extension to the downside and run it back down into this 13 level. But otherwise, I don't like this one because it's in the middle of this bigger range. I'm not at the low of the range and I'm not at the high of the range. And we've got a head and shoulders forming, but even the head and shoulders is inside this range. So then we've got this low and we've come down and we tested it and we bounced and we tested it again. But all of that is bearish because we're setting this lower high, equal low, lower high. We had equal low. That's not good. So I like it short, but we have to break down. And so far, it's not breaking down. It's hard to find a good trade that's at the highs or at a really good key low to break down from to where we got a good longer term signal. So a lot of the trades that I take are just based on very short term stuff. And if it continues to behave well, I stay in it and I look to get more out of it. But before I even get in, I start looking at those pivots, the monthly, the weekly, the daily, and asking questions. What would I need for an entry on this? I want a monthly breakout, a monthly breakdown, a weekly. Then I want to look at the moving averages. Now, I'm not trying to trade moving average bounces and moving average crossovers. I don't want to do that. But I want to know where they're at. Are we above the moving averages? Are we below them? And by how much? If we're really far away from the 10, I'm not really all that interested in trying to grab a trade. It's too far away. So it's a quick perspective. It doesn't take very long. You bring up the moving averages and look, are we above? Are we below? By how much? And then there's some rules that I've put together over the years about different moving averages. And they're not all just my rules either. Some came from Brian Shannon or some came from different books. But the 400 week, for an example, if we're underneath it, that company's broken. Yeah, I do. But not for a trade, right? So like my TRB is an angular support. Even though I wouldn't draw it that way, but I'm looking for it, right? I want that angular level broken. Now, the way I was taught to do things, if the market is falling, your line goes on top because what you're looking for is a topside breakout. You're not really interested in a line on the bottom unless you're looking for the capitulation play, right? That last hoorah where it breaks down and then it runs back up. That would be the only reason you have the line on the bottom of a downtrending stock. And that way you can form your channel and get that last hoorah. Otherwise, if it's going up, you want the line underneath it, and you would only put a line on top if you're looking for that big blow off top signal. And when it comes to snapping these lines, I've seen so many books and videos and webinars, and it's one of the reasons that I got TrendSpider all those years ago because I was so hung up on how should you draw the trend line. Let's do this one. Should we use the wicks or not use the wicks? Should we use the body or not use the wicks and the body? Right? All these different discussions about what's appropriate, what's not, when can I, when should I. Then you bring up something like Trend Spider and you look at their mess. Like, oh my goodness. And you start to realize you can't do it wrong. You can draw trend lines anywhere and everywhere. Unfortunately, though, that starts to become a little arbitrary because if there's no rules, we just do whatever the hell we want. How are we supposed to trust any of these lines? And then I don't like it, right? So for a couple of years, I really focused in on the different types of angular support and resistance lines that we could draw. And now I don't snap the physical line very often. Your eyes get to the point where you see it, and I might demonstrate like this. I might draw it like that, to where I'm not on the wick, I'm not on the body. I'm just snapping a line there so that I can represent what's going on at that level without even trying to get it perfect, right? Because perfection is what drove me to the point where I didn't want to mess with them at all. And there's value there, but we have to come to terms with it, right? So that was my solution. So I do use them. I want to know if we're going to hit one. Like, well, let's just stay on Joby here. Like this one here. If we run back up to the upside, I want to know that that trend line is there, right? But the way that they would do it on TrendSpider is they would ask if you want your alert near that line. It doesn't have to be on that line. It can just be near it. And I like that because, and I'm taking a picture of that for a reason. If you draw the angular line, don't think that it has to be, quote, to the line. Instead, imagine that there's this zone around that line right about there. And that if price gets anywhere in that zone, it counts because it's not a game of perfect, right? And that solves the problem of, oh man, shoot, it missed me by 3 pennies and it fell away. And I think we've all been there. Talk about frustrating and angry. Oh man, I get grouchy. So this kind of solves that problem, right? If we get near it, we can consider it hit. And then if price proves it, even better, we want to see that response out of price. What did it do when it got there? Can we go back and look at it on the intraday, see the order flow, the tape? And then if price was to go back up there again, where would we intersect that level at? If we stay down here for a while and then we make a run, it might be around 18 and a half, right? It could be down here somewhere. If we did it a lot sooner, it could be 19 or even 19 and a quarter. So we want to know for sure where that level is. But drawing the lines can drive you crazy. So if you can visualize it and not worry about getting perfect on it, I think you're good. When it comes to moving averages, there's no um, set of rules, but the 400 week is a really good way to see if it's fundamentally broken or not. It won't be a hedge fund play. They won't pile it into the S&P. It won't get called into the NASDAQ, that sort of thing. If it's under the 400 week, it's an absolute turd. It doesn't mean that you can't trade it, but at least if it's a name you've never heard of and you're thinking, I kind of like this stock, because they do a good job of trying to convince us to buy something, right? Because that's what they're doing. They're trying to get you to buy something, just like ads on TV. They talk you into it. It sounds really good. You go look at the stock, it's under the 400 week. You know that it's a turd. If it was good as a company, as a product that they make, the money management, it wouldn't be underneath the 400 week. So that can limit you on, well, how risky do you want to be? Having a lot of stocks in your portfolio under the 400 week is a really bad idea. Those turds might get some friendly price action when they're getting a capital rotation, or when we see a bunch of short squeezes and the dash for trash sort of plays, when a bunch of just no name junk starts floating to the surface a lot, they'll get our attention, and you can dabble in it and have a little fun, but don't put a lot of those in your portfolio because they're just going to leave you heartbroken in the end if you get too many of them. The 200 is another really good moving average. And we can argue about exponential or simple. I've proven by just putting both of them on my chart at the same time, the EMA and the SMA, that it really doesn't matter in the grand scheme of things, depending on how you do stuff. I don't trade bounces and crosses, right? So I don't need it to be to the tick perfect. But a 200 period moving average is another really important moving average. And how it's sloped matters a lot. So if it's a upsloping moving average and we're falling down into it, it's more likely that we're going to bounce off of it. Even if we set a lower high, it's still more likely that we're going to bounce off of it. And that can be a good short term trade. It can also lead into a good longer term trade. And if we cut underneath the 200, it's still more likely than not to get back above that 200. So that if you did go long thinking it was going to bounce on the two and it doesn't, hang on to it. It will bounce and make a move to the upside, and it will cross back over that 200. Even if it doesn't stay up there, it's going to cross back above. Some of the more famous breakdowns in the last few years go to like Zoom or Adobe, and there's been some good ones. But if you look at the relationship with that 200, you get the rising two, and even when the stock fell down into it, more often than not, we didn't even break. But if we did, we got right back above it again. And sure, lower highs, equal highs, that sort of thing. But that rising 200 gives you context on the stock that you might want to trade. So I'm not saying trade the bounces or anything like that. But when I bring up a stock, I look at where the 200 is and I look at that angle to kind of give me a feel for how's this stock doing. If it's a turd and it has not been maintaining above the 200, that 200 won't slope upwards. It'll be sideways or it'll be downward sloping. And look at this. This is a really good example of a transition period where things had been going really good back here. It was just fantastic. And then it wasn't. So don't split hairs on this. If you bring up a stock and it looks like that, you know what you're getting into. This sucks. Is it tradable? I mean, sure, yeah, anything's tradable. We can get something out of it. But why would we want to? Why not just find something else that has a much better setup? Something that looks like back here or right there, right? Something that had a nice, good, clean run to it and not something that looked like that. And if you're looking for bottom fishing plays that are trying to turn it all around and, climb out of the ashes like a phoenix from the rough, take a look at something like PayPal. It tried to go here, right? Had the sideways 200 and it finally got above and it outran it really fast and it just come crashing right back down again. Now it's not done. It's very likely going to run this dance for a while, but eventually it's going to pull a Carvana. Deep crash, a base for a couple of years. There's the spot where it outran the 200 and crashed right back down again. Stalled out, tried again. I think it crossed it back through again somewhere. There it is. Crossed back through again. But it's a good way to gauge where we at, how we doing. And if we're underneath it and we're getting a good earnings, a strong rally, and we're pushing into the 200. Is the 200 down sloping or up sloping? If it's been a turd and it's under the 2, it's probably been under there long enough to turn the 2 down. We would need the 2 to turn around and start to head back up again. Here's a good example when GM was under the 2, and it had been under the 2 for like most of the year. It made a run towards it, and that run looked really good. That was a nice reversal, solid push, but it's a down sloping 200. It didn't work. Rejected, down it went. Rejected again and again and again and again and again and again. And then then it finally got around, and now it's headed to the upside. But so is the 200, right? So by itself, that's not a trade signal, right? I'm not going to get in or get out just because price touched the 2 or anything like that. But I do look at it when I'm trying to gauge, do I want to trade this particular stock? Where are we in relation to that moving average? Once I'm comfortable with the 200, then I'll look at the 50, the 20, the 10, and really the 50 and the 20, they're not needed. I'm happy to throw those away if I'm on a broker that doesn't let me have a lot of options, a lot of indicators. I throw out the 50 and I throw out the 20, and I just keep the 10 and the 200. Because the 10, I can jump to the weekly, and that 10 is basically my 50. And the 10 week is as powerful to me as the 10-day. So I want to know where that 10 week is. Because if we're bullish, but we're under the 10, we're not going to be able to sustain that bullish run. And we'll be lucky to get to the 10. If we get through it, it's going to fail and we're going to fall back under it. It'll take time to digest, just like this 200, for us to get above the 10 week and stay above it and turn that 10 week to the same shape, same slope, same everything. And for short term trades, staying above the 10 is a really good way to do business. It's still bullish if we're still above the 10 and we haven't hit it yet, right? If we're outrunning the 10. And you can use something like a 310, or there's like what is it, like a an 816 or an 817, a lot of combinations. When you have a stock that's being bullish and it's keeping its surge going, it'll stay above that 3 period the whole way. It won't even get near the 10 at all. No crosses of any kind. And scanning for stocks that are above their 10, that's a pretty easy scan. So if you're looking for short-term fast trades, the stock has to already be above the 10 and it's crossing through the 3 today, or it crossed through the 3 yesterday. That's a good way to do it. That way what you get is things like that. You can get a 310 cross where price crossed and the 3 crossed the 10, and then we kept it until it dies, right? And how do you know that it's time to get out of the trade? Because it broke the 10. It's a nice little swing trade. Now, if we have a pattern, I'll take it into consideration, but I don't trade patterns, right? Like head and shoulders, wedges, cup and handles. I don't trade them just because they're there. I will recognize them. I'll draw them out. I'll point them out. I'll share them with others. Hey, look at that head and shoulders. But I won't trade it just because it's there. So a pattern has a bias connected to it. Head and shoulders, for an example, is a bullish trade if it's inverted at the lows, right? Like this inverse head and shoulders down here. That's a bullish signal. If you find it at the highs, it's a bearish signal. Ah, I lost it right there. Rising wedges are bearish, falling wedges are bullish, right? So you can take a signal and you can get some bias out of it. Yeah, that's a good one. Let's bring that one into the chat. So this was just shared in the chat. Price is above the 4. It's got a change greater than 5%. It has price, or the 10 is above the 20 with strong buys from analysts. And we're looking at common stock. That's a good one. And then you got price above the 200, price above the 50 week. That's also really good. Yeah, but to me, indicators best value is in scanners, right? Absolutely. So you can get brokers that will let you scan patterns, and that's okay, I mean, it's fine. But what I like to use a pattern for is to see if it matches my bias. If I'm already bullish and I see an inverse head and shoulders, well, that makes me feel better about my bullish trade. But if I'm bullish and I see a regular head and shoulders, well, now I'm a little concerned because the regular head and shoulders is a bearish signal, and I don't want to be bullish if there are bearish signals. So if there's a pattern, I want to look at it and take it into consideration. And then there's the narrative. This one's a little hard to explain, but it's really important to grasp, right? And there's two narratives. There's yours, and then there's whatever's happening on the street. So, for an example, pot stocks. They have a narrative on the street. We're all waiting for approval along the state lines and the level from the Fed, so that banks will handle pot money and all the different things, right? There's a bunch of moving parts when it comes to pot stocks. The main thing is they trade as a group, and we're all waiting on legislation. So when the narrative starts picking up, when presidents or vice presidents or high level government officials start talking about legalizing pot, well, what do you think happens? The pot stocks get attention. They start going up. We saw it during the elections when Kamala Harris was talking about legalizing pot, right? Pot stocks started to pick up during the elections. So that's a really good example of a narrative. And then there's things like OKLO and these SMRs and these small modular reactors. And those companies don't even have a physical product to sell you, right? They don't have anything but a pipe dream. And yet, as a space, they all got hot. And everybody was talking about how we need the data centers and any energy is good energy and blah, blah, blah. And so any energy stocks connected to that went up. That was the narrative. That's the public one. But I've also argued that if you can, you want your own narrative. That usually ties into those traders who trade a particular name over and over, like a cult stock following. There are Tesla traders who only trade Tesla, and there are AMD traders who only trade AMD, right? I'm not knocking them because for a long time I only traded SPY, right? What do I care? If you're trading the same thing every day, you should try to continue a running narrative so that when you bring up the chart, you can narrate every one of the behavioral incidents that are on there, like that big day. What was that big day with that big gap down right here? Car deliveries? I mean, I don't honestly know, but if this was my stock that I was trading every single day, I would know what that big breakdown was. Maybe that's when he got into a fight with the president, right? Or who knows, right? But you want to have that kind of running narrative. It's really easy to do on things that you trade all the time. Say like SPY, to where we can look back and we can be like, oh yeah, that was that Jackson Hole moment back in 2022. Well, I went back too far. There's the Jackson Hole mic drop moment when it rejected off of the 200 period daily moving average and dropped like a rock. When Powell did his whole drop the mic moment, and there's the Japan intervention down here. Or, you go back to 2018 and the Christmas plunge protection team midnight meeting where they rallied the market out of the ditch back here. Every one of those is an event that I remember from trading, right? You can kind of carry your own narrative because you trade that thing over and over and over and over again. So, do we have a narrative? Is something that I like to cover in the stocks that I trade. And I don't like ones that I don't know because I don't have a narrative. Then I have to rely on the narrative of the street. Of course, we trade it anyways, right? Just saying, I like it better when I have my own. Does it have options activity? Now, this is a little sneaky. We have options data in the Discord, right? So if I'm looking at something like Meta and its current behavior, and I'm thinking I might want to go long or short, I don't know. We need to take a look at Meta. All right, let's say I want to trade Meta to the upside for whatever reason, and I think that this is going to hold that half back. Do we have any unusual options activity in Meta that might agree with this, or that tells me I'm wrong and that I should stay the hell out of my long trade? Maybe I should short it. So I'll go in and look at the unusual options activity. Now, guys, I got a lot of tools. I got a lot of tools. I don't need the free one here in the Discord, but there's no reason for you to go out and buy a bunch of options tools that either A, you might not know how to use, B, you might not be able to afford, especially if you're not profitable yet. Don't go do that. Use the ones that you got here for free. So I can see today it has some option sweeps. And I can see over the last few days or even the few weeks, if I want to, if there was any news, any unusual options activity, it'll show up in this scan. That way I can kind of get a feel for, hey, what are they doing out there? Have they been hammering this to the upside, to the downside? Sure, it takes a little bit of time to go through these and see what are they, but it's free and it's giving me some insight on the options that I didn't have to go buy, right? The 660 strike for January 20th of next year, two large sweep orders came in. They spent almost $300,000. That's not bad, right? Back to back meta orders, 660 and 760. They were both done at the same time, within moments of each other, 3 minutes, 4 minutes. That's probably the same individual, probably. But we would know where to look, right? We would know, oh, we need to go to the January or February strikes and look at those options and see how many more are there and what's going on in that area, right? It gives you something to look for. So is there any unusual options activity? And does it agree with my trade or not? Hey, don't feel bad if you look and you don't find anything, right? Like you're not supposed to. It's called unusual for a reason. It means it doesn't happen all the time. If you look and you don't find anything, then okay, so what? At least you looked. Because I promise if you don't look, well, you're never going to find anything because you didn't look. What's the risk? Now, we were kind of talking about this earlier in PLTR, but I got to this a long time ago with Tasty Trades. Tasty Trades has this mantra that says trade small, trade often, that it's all about occurrences, right? What do we mean by that is if you trade something that has a statistical probability to it, but you only trade it one time, well, then those statistics didn't help you out at all, right? You can take a 90% win rate trade, but only trade it once and you could lose. And of course, you're going to be upset and say, what the hell? It had a 90% chance of winning. Why did I lose? It was one trade, one time. You don't have statistics, you just have one occurrence. So, what Tasty argued is options are all about statistics and probabilities. And if you want the numbers that you know that trade has, the 90%, the 80%, then you have to trade often enough to get that success rate. The more, the better. Well, of course, that can get really expensive really fast. And it's a lot to juggle, a lot to manage 30, 50, 100 trades. I had only been trading for 9 months, and my average trade size was 400 plus trades at once. Sounds like a lot to juggle, but really it's not because it's all or nothing. It's either going to work or it isn't. If you trade it small enough where you don't give a damn, you don't babysit it, you don't monitor it, it's either going to hit your price target and it's going to close the trade, or it's not and it's a loss and you don't even look at it anymore. Trade small, trade often. So, what's my risk? I don't care what the trade is. If it's $2, and I'm talking two pennies, right? Two options pennies, that's $2. If it's $2, I don't care. You don't have to convince me. I don't need the full story. You want to go long and risk two pennies? Let's do it. Let's go long and risk two pennies. I don't care, right? Because it's two pennies. I don't care. Maybe it works. Maybe it don't. Especially if that two pennies can make me $20, right? 2,000 is what $20 is in options. Heck yeah, sign me up. I will risk $2 to make $20. So when I'm looking at a trade, if I can keep the risk small enough, I don't care if I have a signal. I don't care if I have a bias. I don't care if it's really on support. It's worth a shot. It's just this small amount of money, and I will put it on. Preferably at the money or near the money, not some way out of the money junk. But yeah, if you've got the risk under control, then why not? And if you don't have the risk under control, then what are you going to do about it? We can do things, right? We can find an alternate stock. We could find an ETF that has that stock. We could trade a spread or a butterfly or a vertical or something that we can do to make the loss or the risk of loss much smaller. And if I can't do that and the risk is really big, I don't care how good it looks or how many signals I have. If I don't like the risk, I'm just not going to trade it. There's no signal good enough for me if I don't like the amount of risk that's in that trade, I'm just not trading it. And I know that that goes against the way a lot of people trade because they'll say, well, I'll just use a stop and I'll make the loss limit or the loss risk the size that I want it to be. I get that. And sure, I mean, that's what we have to do when it's SPX, and it's often what we have to do in like really expensive stocks, but most of the time, no. So now I got some links to share with you guys. If you're looking at a stock, you want to be able to ask a question. Have they filed for dilution? That's a real big deal. JOBY, for an example, it's one of those EV stocks. I love those EV stocks. These were a great play at the beginning of the year, but these are not profitable companies. They're just like those SMRs. And they are smart enough to take advantage of this run to issue more shares at these levels, right? They want to bank on that as much as possible. And most of them did. And they were offering dilution levels up here, right? So they want to offer more stock. They want to sell that stock. And of course, if you dilute the stock, that sucker's going down. And that's what happened here, right? It was like October, it was in here somewhere, like October 8th, something like that, big gap down. There it is. That was dilution right there, that big gap. Well, they don't do that without filing the paperwork first, right? You can't offer the dilution and then go file the paperwork. It doesn't work that way. So you can go to the government website and check to see, do they have a dilution filed? That doesn't necessarily mean that you're going to know the day that they do announce the dilution, because that they can keep secret until the day they just decide to tell everybody, we're going to dilute tomorrow. Ah, shoot, right? And then down we go. But if there's not even a dilution on file, you know that there's not going to be a surprise tomorrow where they announce a dilution. If they have one on file, you know that that's a riskier trade because at any minute they could announce that they're going to dilute, right? So this is the SEC filings, this website right here. And if you go to that website, you can search by name, and it's going to the filings, there's like four different ones, and one's an emergency filing, which means they can file and then report in like 4 days. That's the fastest one. The others are for bigger companies that have that doesn't file dilutions very often, right? So if you get an answer, let's put Joby in there, and you get a lot of different things that show up, and you're not quite sure what to do with it, give it to your AI. Let it figure out what the answer is. So there's the filings, right? Let's see, where is it at? Come on, give me a Joby. I know you got Joby because I grabbed it earlier. Now it doesn't want to show it. Ah, I grabbed one from Joby earlier. I was going to use it for my example. Let's see. Here is it. Where is it? There's right here. Now, if you look, it's got the 8K and then it's got the 144 and then another 8K. So if you're getting a lot of different ones and you're like, shoot, I don't know what that is, right? You got the 701, the 901, the 801, another 901. Send it over to your AI and ask it to analyze it for you. That's what I did with that image, and it broke it down for me, right? After a while, you'll kind of just get to that point on your own and you won't need the AI, but there's no reason to stress over it. Let that thing figure it out. And then it'll tell you, hey, they've got a report filed and it hasn't been claimed yet, or it hasn't been submitted, that hasn't been announced, which means they could drop us at any time by coming out with an announcement. That's what happened. I hit enter instead of clicking the button. All right. So on the link that I shared with you guys, when you put your symbol in at the top, don't hit enter or you end up on a page that looks like this. All right. Instead, type in what you want and it'll offer you choices down here and click the one you want, which will be the top one, right? Every company has a number to it, and the number won't make any sense to you and me, but it does to them. So, yeah, I did. I took a picture of what we're looking at right here, and then I went over to AI and I said, "Hey, this is what I've got for Joby. What does this mean?" And it laid it out for me, right? So I'll copy its response. Yeah, I have JOBY here. What does this tell us? That was my question. And here was the answer. I'm going to make it into a thread, right? Just so it doesn't spam the chat. Nope, it's too big. I got to cut it a little bit. All right. There you go. Just click that thread and then you can read the answer that it gave. Okay? So the idea behind this is what I would call a forced error, right? Like when I tried to short Target or I tried to go long Target in January without realizing it was going to announce their December Christmas sales one year. You live and learn, right? I got my butt handed to me on that trade simply because I didn't ask a basic question. Is there anything I need to know about Target in January? Yeah, they report their December sales in January. That's something you really need to know. I didn't even think to ask. So I went long. They reported their January in their December stuff in January and it kicked me in the head, right? That was a forced error on my part. Well, stock dilution is another one that we can ask for. All we got to do is go ask. If you don't ask, you're never going to find it. Another one is the short report. Now, that's usually going to be on names that you don't know or on names that are coming up from under the 400 week. Um, those turnaround kids, stuff like that, right? You could ask if it's had a dilution filing and it could look. You could do that, but the website allows you to search for the name, and I don't trust AI, right? I really don't. I use AI every day, and I see the errors that it makes all the time. If I have to double check on whether or not the company actually has submitted for dilution, then I'm just going to skip the middleman and check to see if it's did the dilution, right? Because it takes 2 seconds to put it in on the website. What I would use the AI for is, hey, I found this when I searched for dilution. Tell me what it means, right? Tell me, is it the emergency dilution or is it the regular dilution? Or because some of the dilutions, they're not actually dilutions. They're inside sales or they're employee gifts. And so you're going to get a lot of answers. And unless you know what every one of those answers are, just give it to AI and ask it, hey, which is the which, right? And of course, it can screw that up. It can screw it up. If you're in doubt, just give it to two different AIs and see if they answer you the same way, right? But the good thing is once you get the answer a couple of times, you'll know that the 901 is for gifts and inside selling, and the other one is for emergency. You know what I mean? Because there's only like 5 numbers that you can get. And once you learn those 5 numbers, that you won't even have to ask AI. The short report, this one I honestly ask Google most of the time, right? I don't know if you guys do this, but back in the day before we had AI for everything, I would just go to Google and I would ask Google questions in a question format. I still do that when it comes to the short level of a stock. That's usually how I do it. What is the short interest in or on whatever stock, right? Now, you don't have to do it that way. There are websites that you can get that for, and it doesn't cost you anything. So here is a short report website called Fintel. It's free for right now. That might change eventually, but they are offering people, free access. And even without an account, you can still see the answer if you want to use that and go look at a particular stock. But when it comes to short interest, you can just ask Google and you'll usually get a really good answer. If you don't get one, then you can always go to the website, because I've asked and sometimes I don't get an answer. So then I'm forced to go to the website anyways. What I like about asking Google is a lot of times it'll give you the date of it. And if you don't like how old the answer is, then you can go to the website too. Most companies report their short interest with their earnings. So, if you're paying for something really expensive like Market Beats, or not Market Beats, that IBD tool that shows you monthly updated short interest. Um, Unless you're paying for something really expensive, you're probably only going to get the earnings announced answer anyways. But it's better than nothing, right? And if it's a name you don't know, and especially if it's something that's coming up out of the bottom, you want to know the short interest, right? Cheaper stocks, newer companies that's been beat down and they're trying to come back, you want to know the short report. And then there's institutional holdings. Now you can get that from Yahoo Finance. It's free, doesn't cost you anything. Or you can go to that Fintel. But like I said, I don't know how long we're going to have Fintel. Like I've only been using it for a little while, and it's because I only recently found out about it. It's free. Why not? I bet it won't be free forever. So when it's not free anymore, go to Yahoo Finance. That's what I used to do. When you go to Yahoo Finance, they have an about section. So you can bring up a particular stock. Um, we're going to look at Archer instead of JOBY since I'm picking on it. Maybe sometime today, sweetheart. Oh my goodness. Got to give you a candy bar or a Red Bull. There you go. That's all it took. Just mention Red Bull and it got it done. So I looked at a stock, look on the left hand side, and you want to find the here a little bit. You want to find the holders section. What we're looking for here is institutional participation. That's some big words on a Monday. Yeah, I got it. Go away. Okay, so first, who are the major holders? And then how much do they have? And what is the trend within those holders? Are more banks and institutions holding more of it every year, every quarter, every month? Or are they getting out? Because if they're getting out, they'll do it slowly. They don't want to spook the market and scare everybody and then crash it while they're still holding a lot of it, but they'll exit out of it a little at a time, and we can see that trend over a 2, 3, 5 year period. We can see them getting out. So only 54% of the shares held by institutions, or 65, let's just round up, 65% of the float is held by institutions. There are 575 institutions holding shares right now. The problem with this snapshot is, hey, what was it last quarter? Was it below 575 or higher than 575? Because I want to know, is that number trending lower or is it trending higher? And this doesn't tell you that. So that sucks. But at least you get the number, right? It's very likely that you can ask AI also, what is the institutional participation for Archer over the last 2 years? I don't know that we can do this, but I'm betting we probably could, right? It's looking. My phone went bing. For some reason, it's dying. We'll fix that. No quitting. Quitter. So I think maybe I confused it. Like I said, I wasn't sure that it would even work, but why not? All right, so it finally made sense of the question that I asked, and now it's looking back over the last 3 years to get the answer. So that's the idea, right? You just want to know, hey, is there a bunch of short interest in here? And if the short interest is high or low, and if the institutional investors is growing or not. I don't know that I have a particular number that I want to see per se, especially when it comes to the smaller companies, because you wouldn't ask that question of like Amazon, Meta, Microsoft, right? Like you wouldn't even you wouldn't even try to ask a question like that for those big names. This is generally something you would ask about a smaller company or a company you don't know. And so it's hard to put a number on it and say, well, I want at least, this much number. Generally speaking, above 50% would be common, right? That I would be surprised if I ever saw a number less than 50%. And if I did, it'd probably be in something really old like GM or Ford, AT&T, something like that, right? I couldn't look at it. My phone said it was dying. 70% is good. Yeah. It shouldn't be surprising though, right? Banks underwrite most of those companies, especially if it's a newer company or a company that isn't actually making a product yet. The banks are the one that started the whole thing off. If I start a company and I want to get on the exchange, it's complicated, right? How am I going to get on the exchange? I'm going to talk to the banks and they'll be happy to do it because they get most of the shares, right? They're going to be the underwriters of the shares. I shouldn't say they get most of it. That's an inappropriate statement. They're the ones that's going to underwrite it and they're going to get a nice big fat part of it, right? So why not, right? So they'll pony up all the upfront cash and they'll expect to get a really good chunk of the pie. They are the underwriters. And if it's really big and that one bank can't do it by themselves, then they'll call up their buddies at another bank and they'll say, hey, we're running this deal. I got this sucker that doesn't know what he's doing. We're going to help him get on the exchange and we get this big fat bonus out of it. Come help us underwrite it. Right. If you haven't seen that Netflix show, We Work, check that one out. And of course, it's television. So, it's not the numbers that you hear won't be accurate, but you'll see that same situation between a couple of banks with a company that has really lofty valuations that it didn't earn or deserve, just offering a line of credit because they were a company that was hot and they were able to sell shares and people were buying it. Because remember what I said earlier, they're just trying to sell you something. Yeah, yeah, I agree with that. You know, he's not in the chat. Um, Jack Frank was asking a question about getting Thinkorswim to adjust something. The platform has looked the way that it looks for 30 years, right? With barely any changes whatsoever. And getting indicators added has been an absolute nightmare. So Brian Shannon, I think, was the last public person that I ever heard talk about getting an indicator added to the default Thinkorswim. Oh, the guy that did the squeeze indicator, the squeeze pro, I believe when they interviewed him, he said he gave up, right? Like he wanted his to be installed, but with restrictions so that he could sell it. And he went through everything he could think of to get it on Thinkorswim built like that. And finally he just said, screw it, I'm done. And he gave up. But he did get his indicator onto Tasty Trade so that if you wanted to trade using, what is it, simpler trading? Yeah, those guys. If you wanted to use simpler trading's indicators on Tasty, you have to buy it on Tasty. I didn't even know Tasty Trades had private indicators that you could buy and load onto the platform until I seen that article from Simpler Trading about it. So I know today's stream is a little bit in the weeds, right? But it's really important to be able to ask these sort of questions and find out what's going on with a stock that we really don't know a lot about. And maybe we want to trade, maybe we don't. And look, I don't ask that question on every single stock, every single time I go to get a trade. It really depends on how long am I planning on getting it? What kind of trade am I going to do? You know, if I'm just in and out short term, couple of days, a lot of times I don't look. Plus, once you've looked up a name, you know the name, right? So, I tend to be really picky about the things that I trade. I'm a snob when it comes to liquidity. I really want good liquidity. So, I don't trade a lot of unknown names, but it's really simple to look. So, why not? All right. So while we're on the subject of looking at things, on Thinkorswim, you've got the fundamentals tab. This is a really good tab. So to help you get there, we got the different menu levels, right? You want to go to the analyze tab and then choose fundamentals. We're going to bring up JOBY again. We're just picking on those EVTOLs. You got 5, sometimes 6, because usually one of these is grayed out. You got 6 reporting companies here that will give you some depth and analysis. And this isn't just a Thinkorswim thing. If I go to Fidelity, they have something very much like this. And it's the same report. It's CFRA, it's Market Edge, Argus, Morningstar, plus they have their own in-house one, Fidelity, just like Schwab has its own in-house one, the Schwab Equity Rating. You can go to the Schwab website and do the same thing. So this isn't all from Schwab. Market Edge is its own company. You can get a subscription there. You can do really cool stuff at Market Edge, by the way. I got a, I don't know if I want to call him a buddy, but I know a guy that uses it. Well, let's say it that way. He really likes it, but he's not like a trader like you and I would be considered a trader. He's more of dabbling in investing. But you can get a Market Edge subscription that offers all kinds of services, including looking up a company. And you can get earnings, you can get their risk assessment, what they see as competition, how wide the moat is, what they see for forward earnings guidance, all kinds of stuff you can get from these guys. Yeah, here they're trying to sell you something, right? You can get 60% off if you're a Schwab customer with Market Edge Platinum. Yeah, whatever. But still, it's more insight, right? I don't see the earnings analysis that I was looking for. Probably going to have to go to CFRA to get that, but I like that one, and I like the one that says these are the things about the company that we're worried about. Because especially if I don't know a company, please tell me what you're worried about. That way I can be worried about it and I can keep my eye on it. Maybe I don't even want to trade it. So here's CFRA. Joby's a big sell because they don't like to take risk. Um, but if you scroll down, it should get to the analysis part where they write up this is what we think, right? Somewhere down here. Should be. There it is. Risk evaluation. This is where they start talking about the things that they think are a negative. Usually it's something like this company has competition from these other companies. They make a better product, they sell it cheaper, and they've been around longer. So they have um, a lot more loyalty in their client base, something like that, right? That kind of write up. Yeah, here's their peer group. Didn't really, they didn't really offer much. This is just the glossary part. But if there is a peer group, they'll list it, and they'll rank that name against its peers. So it's not a bad write up. But if you guys are going to use this, and remember, it's not just think or swim, a lot of brokers have it. Check the date. Don't assume that it's current. Oh man, I've made that mistake. You go in, you don't even look at the date, you just click the button, you get the report, you start reading it. If you're lucky, while you're still reading the report, you realize that it's old and you're just done and you stop there. If you're unlucky, like I was, and you don't catch it at all, then you start putting trades on based on old, outdated information, and then that's bad, right? So check the date. And then some of them, the link just won't work, right? Like it just happens that way. Um, there's not much you can do about that. But every one of these does have their own website. So you can go to Morningstar and LSEG, Argus, all of those guys. And it doesn't cost you anything, right? It can if you want subscriptions, but it doesn't have to. So that by the time you're done analyzing a stock, you'll know if they have unusual options activity, if they have filed for dilution, their current short status, and what the institutional holdings is at. That'll give you a really good idea of your risk. If you're just in and out in a week, most of that is going to be too deep, right? Like, who cares? It broke the trend line. I'm going long. I'm going to run it for 3 days and I'm out. Cool. It doesn't matter. But if it's going to be something that you're going to hang on to for a while, maybe even build a bigger position off of, eliminate your exposure by checking those things just to make sure you're not holding on to it when they do this. You can stock split or a surprise dividend or, dilution, anything like that. I didn't write it down, but this is another one. What's the widget? This is not always easy to figure out. So, my example, Target. I'm serious. I went long in Target a couple years back. It's been a while, but it's one of those you don't forget after you get your butt handed to you. Where if you had asked a simple question, you would have saved yourself a loss. There it is right there. So we had this gap up and stall to the next earnings, and then a gap and run to the next earnings, and then a gap, and we were on our way to the next earnings, right? Here is the new year right there. And we were in this gap, and we already had that one, and we had this one, and you can see it, right? Earnings to earnings to earnings, and then, here's the next earnings way over here. So I thought, hey, this looks good. We will run it for, a month or so, get kind of close to March earnings, and then we'll get out of our position. Got in, and I swear it wasn't even to the end of the week. I got in on like a Monday or a Tuesday. By that end of the week, that sucker had gapped down on me and just continued to drop. Why? Because of its Christmas sales, right? Now, once you know that it's going to do this, that it reports in January, then maybe you don't take the trade because you're waiting on the report like everybody else was waiting on the report. I didn't wait. I got in and got kicked in the face. So if you know what the company's widget is, you know what to look for. Tesla reports car sales. When it's not earnings, they report car sales, right? There's a particular time that they do that. Um, Amazon has Prime Day events, multiple Prime Day events every year. Earnings are easy. We know where those earnings are at. But what other things do they report? And when is the next one coming? And are they going to be at any big show, any big conference? Is there an investor day event coming? Anything that you can find out that's coming, it's going to be a big headline. Try to find it. The problem is there's so many things that it could be that unless you already know, how are you supposed to know? So if you can go to something like FinViz, FinViz is a news aggregate website, and it does stocks and charts and that sort of stuff. But they grab news from all over the place. What you need is a place where you can go back a long ways, right? I was hoping they would go back farther than that. October 30th, that's not enough. If you can hear of news to where you can look back and try to catch headlines, especially say in January for Tesla or Target, right? What did they report last year in January? What was the headlines? That way, if you see something like the Christmas sales numbers in January, then you know, oh, shoot, you know what? It's January now. I think they're going to do the December sales. I better not take this trade. It sounds silly, but man, that's a lifesaver. And that's one of the reasons that I used to get Seeking Alpha. Seeking Alpha is really good about doing that over the weekends. They have this report called the breakfast something. I got rid of the subscription and swapped it out for another one, but the only reason I even had that subscription was for that one publication that would come out on the weekends. And what the publication does is it tells you events like that that are coming out next week. Like, oh, hey, there's going to be a big pot stock convention next week, or there's a big AI convention and these companies are going to be there, blah, blah, blah. Man, that's really helpful, right? That Intel trade faded back quite a bit, didn't it? The Microsoft one is just stewing though. It's not doing much. We sold it for 175. It's not negative anyways. The Intel one, it's still positive. Not juicy, but it's there. Where are we at? 586. It's okay. One of the reasons that I got rid of the Seeking Alpha though is you don't need it anymore. You can use AI for that. AI is not awesome when it comes to dates, right? It's one of the biggest screw ups that AI has is dates. Ask Marziti about that one of these days because that's like his biggest pet peeve when it comes to those AI bots. But you can ask AI, hey, what is Google's yearly event schedule, right? Or hey, does Google have any big events in the next 1 month or 6 weeks, 2 months? The problem is you got to ask it about all kinds of names, right? So you can do it another way around and just ask things like, hey, is there a big semiconductor conference or big semiconductor event next month, a big AI event next month? That way you're not asking about individual names, but instead about events where a lot of names would be there. Yeah, don't get me wrong. I like Seeking Alpha, but after that first year where you got a really good price, the second year they want to gouge. And I refused to pay up for that second year and I got rid of it. So these sort of what I call forced errors, if you can eliminate as much of those as possible, the better, right? It still isn't a guarantee that you're not going to lose, but at least you'll be eliminating the all the gotcha ones, right? All the times where we got a trade and 3 days later something comes out like stock dilution and we're saying, "Oh man, what? I wish I'd have known that 3 days ago." Now you will, right? All those EVs did that this year. Probably a lot of those miners did too. All right, so we had some questions about the high low graph and this scanner that I use. Now, I don't have mine adjusted to help me find something to trade. I have mine adjusted so that I can look at the broader market and ask, hey, how's it going out there? Okay, so let's look at the settings that I'm using. You can see it's really simple. I've got it locked in to things that are having penny increment options, and I removed all the ETFs. So SPY and IWM and all those, they don't show up in here. And if I hit go, this is my bullish one, and this is all the bullish names right there. That's not very bullish, right? That's like a small handful of names. And if I looked at the bearish one, if it was, you know, 10 times as big, then I'd know we're really bearish out there. What I do with that information is compare it against what I see in the S&P or the Qs. This isn't very bullish or bearish, but look at how many names we have on the bullish side versus the bearish side. Obviously, we've got more that are green than we do red, but that's not a very good example. It's just the market's about done for today, and so that's what we've got to work with. What I use that for is, say we're at this situation. We're at the highs and we're kind of failing and we start to pull back. If it's way more bullish, and I mean way more, not this little bit, but if it's way more bullish than bearish, I'm not trusting that this pullback is real. And then what names do we have in there? If it's a bunch of old tech, when we do see tech, I want to see new tech. I want Mag 7 things and consumer discretionary and chips, cloud services, those sort of things. I don't want old stuff, HP and Dell, IBM. I'm not looking for that. So I want to see what sectors are in here, what names, and then how many names are bullish versus how many are bearish. And it's just another signal. I'm not going to get long or get short because of that, but it helps with the bias. If we're going sideways inside of our own range and this is turning really bullish, it doesn't mean we're going to break out, but it does imply that if we do get a breakout, it's probably going to go up, not down. So it's just another tell, another gauge on the day to be able to look at it and say, what do we got? More names that are bullish or bearish? And then what do we got? What kind of software names are in there, or financials, consumer discretionary? Just trying to get a feel for what the market's doing. Most of the time, what these say are happening is what you'll see in the stock price most of the time. But if you don't, that's another one of those tells, right? So if we're melting down all day long, just down, 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 down all day, and yet it's more bullish, then you know that there's something wrong with that down, down, down. It's not the broader market at that point that's driving the S&P or the Nasdaq lower, it's something else. So we know, okay, it's not the 490. It must be dollar bonds, maybe 0-day options. It's something else. So we know to look somewhere else. On the swing trade strategies, by the way, there's no way to eliminate risk, to eliminate loss, right? We can reduce risk, but if it's going to lose, it's going to lose. And there's nothing you can do about it. No matter how perfect the trade, no matter how good the setup, whether you wait to get in or you get in now, I've heard it all. I've tried it all. At the end of the day, it's either going to work or it's not. And trying to solve the riddle of, I want to make sure that my trades never lose. Well, you can't. It doesn't exist. So we want to go through the list and try to remove as much forced errors as we can. We want to trade in a good market environment. And if all the conditions are there, then we just take the trade, right? Like, I know that it sounds really kind of Captain Obvious stuff. Like, yeah, no kidding. But you'd be surprised how often I hear from new traders who don't understand that there's no way to make sure you don't lose, right? There's not. You're going to lose. So we want to keep the losses as controlled as we can, you know, get out of them as quickly as we can, minimize them as much as possible, get as much from the winners as we can, and move on to the next one. So I don't stress too much on, hey, it's not the right signal, or, it already, it's still moving up. Why are you trying to go short or whatever? I've heard a lot of people wondering why I do what I do. But it's a little bit of fatalism, right? Like it's going to do whatever it's going to do. There's nothing I can do about it. I'm going to go long, I'm going to go short, and if it doesn't work, this is the risk that I have. A neat little trick that someone told me once is imagine that every trade you take is going to be a max loss trade. Before you get in, just imagine, all right, this is a max loss trade. You still willing to take it? Now, we all know if I buy a $900 option that I don't have to lose $900, right? I can close it as soon as I open it if that's what I want to do. So if I buy that $11 call right there, I don't have to lose $11. But imagine your loss is going to be the full loss, that it's just all or nothing. Would you still take it? Because what I found when I asked that question, it has kept me out of trades. Now, there's a lot of trades, so I'm not stressing that I didn't get one. I never have a problem of not being able to find a trade. That just doesn't exist for me. I can always get a trade if I want another one and then another one and another one. I can trade all day long. So what I'm looking for is a reason to not take the trade. Talk me out of this thing. So when I'm looking through all the data and the indicators and the lines and the levels and the drawings and the info, I'm not looking for something that says you should do it. I got this little sneaky devil on my shoulder who's telling me the whole time, just do it, man. Buy it, get it, take it, do it. So I don't need any convincing. I need someone to talk me out of the trade. So when I heard this little tip, that imagine the trade as a full loss. Your only options here is for max profit or max loss. Would you take the trade? And if the answer is no, walk away. You'll start to develop and build trades at an acceptable loss level. And it still doesn't mean that you have to lose the whole trade because that's what management is for. But you'd be surprised at how much that'll keep you out of trades that you probably shouldn't have been trading in the first place. It helps a lot. Anything that you can find that helps, right? We all got our own thing. All right, guys. Anybody got any questions? I can't believe we made it through. I thought for sure we'd only make it like halfway. Yeah, guys, Angel's awesome. This place would have fallen apart years ago if it wasn't for her. There was a request to trade Friday, um, either stocks or futures, doesn't really matter. It's going to be on paper and we're going to trade something. It won't matter because it's paper, right? So normally we don't trade on Friday afternoons because there's just no new swings that we want to get into. But since it's going to be paper, it won't matter, right? We're just going to be getting in, working the order, talking about what we're looking at between the bid and the ask and the data and the information, moving the order around, working the order. And I think we'll have plenty of time to do stocks, options, and futures. We're not going to be trying to make money, right? We're just talking about when to get in, positioning the move, right? That sort of stuff, especially from a day trade perspective. Because I get a lot of questions on this on a daily basis. And it works for futures, stocks, options, the concept, anyways. But I think we're going to get onto some of that Friday. Of course, if you guys got recommendations of something that you want to talk about, topics, hit me up. I'll add them to the list. We can always do that. But if we don't have topics, I think we're going to be putting some trades on Friday. And we're going to do it in the different products like the stocks and options and futures to kind of go over some tips and tricks on doing it easier, faster, better. And this isn't necessarily about candles. It will be on stocks and futures, but for options, it's going to be based on more than that, right? Because we got to look at the options data and all that. But there's ways to trade options faster, cleaner, easier. We're going to get into that. And then that age old dilemma of, do we let the candle close and then we get in, or can we get in while it's still doing this, that, whatever? I'll show you that the answer is really a catch 22, and that, you eventually have to decide for yourself how you're going to do it, and that there's no wrong answer except to just jumping around from thing to thing to thing. That can actually add to more losses. So when it comes to the fib part, what exactly are you talking about? Taking an entry off of the fibs or using the fibs for tradable logic? Because, entries off of a fib is the same entry that we would do off of yesterday's high, yesterday's low, a half back, right? It's the same thing because a pivot's a pivot, it's a pivot, it's a pivot. All right. So options trades, working the order, setting the exit logic, setting alerts. Thinkorswim gives you chances to set some really cool alerts when you're going to do options. It's fantastic. Um, on d- we're going to just say it's day trades, but it'll work for everything. Day trading pivots, and of course those pivots can be floor pivots, any line, right? Any line, whether it's the ADR line, yesterday's high, yesterday's low, a floor pivot, a CTR, any line in the sand, angular, straight, horizontal, vertical, it doesn't matter if it's a line, that's a pivot. How to trade off of that pivot. Oh my goodness. Yeah. It's late, huh? Um, I don't do the Qs look like a double top? What time frame are you thinking about there for that double top? The daily? You talking about the distance between these two wicks being a double top? Yeah, we would call that a micro double top. Remember, price is fractal, right? So if I was looking at that on a 5 minute, would I still consider it a double top? If we were using OCR analysis, the answer would be yes, that's a double top. And since it's fractal, we could say the same thing for a 30-minute, a 15-minute, a 5 minute, a 1 minute. Right, micro, a micro double top. That's exactly how you would want to say it. Now, for me, though, I've got this age old argument about double tops and double bottoms. A double top is a bull trap, right? When I think of a trap, I always think about that round steel spring trap, and the animal walks into it and their foot presses down on the trap and it closes on them. To trap an animal, you actually have to get them into the trap, right? If this is a bull trap, wouldn't we need the bulls to be there to trap them? And if it was a double bottom, wouldn't we need the bears in there to trap them? So, what I've always argued when it comes to a double top or a double bottom, I've got a good example here. So, I'm going to use the double bottom. Is if that is my bottom and we run up and we run back down and we get a new bottom, I need the bottom on this new one to go deeper than the previous bottom so that I can trap some bears in it. And then those trapped bears buy and they add to the buying, and we get this explosive buying move back in the other direction. That's what makes double bottom so great. Same with a double top. If a double top is a bull trap and I'm going to trap those bulls, then I need to go higher than the previous high to get the bulls into the trap so that when we spring it closed on them, they start selling, which adds to the selling, and we go down really fast because we trapped some bulls and we're dumping it down. If both of the highs or if both of the lows are the same size, we never got any animals into it, long or short. We didn't trap them because they never got in. And that means we won't get the aggressive selling that we should have got because we didn't trap any of them. And instead, it's more of a cup shape or an inverse cup shape. And those lead to a handle and down or a handle and up. Now, that's my particular take on tops and double bottoms. The textbooks and a lot of analysts will disagree with that. And they'll say, oh, it doesn't matter if it's a matching top or one's a little higher or one's a little lower. It's okay. It's fine. I don't agree with them because I'm looking for the outcome. The outcome being I want the aggressive selling or I want the aggressive buying. Now, see, there's a good answer, right? If I get off of the daily and I get inside, now I've got there's the cup, there's the handle, there's the cup and handle. But I'm not on a daily anymore, right? So at this point, what I see is a possible, well, I see a cup first. And since we sold off, we have a possible handle. And this might turn into a market that just goes right on back down here for all I know, right? Because price can do whatever it wants. So it might just come right on back down again. But since we didn't get higher than this high, we didn't trap any bulls here. I don't consider this a double top because double tops are bull traps. And if we didn't trap any bulls, then it isn't a bull trap. And that means it's not a double top. It's a cup that may or may not have a handle. The reason I do it that way is so that I can stay consistent all the time. What is the difference between a cup and a double top? And it's a fair question, right? Like, honestly, what's the difference between a cup and a double top? I personally needed an answer to that question because it was driving me crazy. I needed a really good answer to that question. A cup is bullish, a double top is bearish. Okay, I think we can agree with that. Even the books agree with that. So if a cup is bullish, then I need other things to add to the cup analysis that tells me I should be looking bullish, right? So what else does a cup normally do? Pulls back and gives us the handle, or it breaks the previous high and it just keeps on going because that's what cups do, right? They just break the previous high and they keep right on going. That's the two things that a cup does because a cup is bullish. A double top is bearish. What do double tops do? They exceed the previous high. And that's fair. That's what a lot of textbooks say. A double top is resistance around the same level where price wasn't able to close above that resistance area. That's exactly what the books say. So you're not wrong. But to me, I will treat that as a cup and I'll treat the other one as a double top so that I can differentiate between the two, right? Because one is bullish and one is bearish. And and if they are both the same description, how am I supposed to know which one is which? And for tradable opportunities, the way that I build it presents a tradable outcome, right? So if this had exceeded the previous high and gotten above it, I would be looking for a 111 or a 1236 so that I could trap those bulls and short this sucker, right? That isn't what we got, but that's what I would have been looking for a really good double top. Trap some bulls up here and then short that sucker. Since we didn't do that and instead we rejected, I never had a short trade from a bull trap perspective. I didn't have a short trade. If we just wanted to look at anything else like 3 bar reversal or any other reason to short that, then we could have done that, right? But we didn't have a bigger setup. There's a nice 3 bar reversal, or there's a nice 3 bar reversal, something like that. If I had a pattern, I could have shorted it, a signal, a reason, but it wouldn't have been because it was a double top. We'll get into that Friday, but the main answer that most people don't like to hear is that you can get in it depending on your aggression level and it won't matter, right? It really, really doesn't matter because if the trade is wrong, you're never going to know it's wrong until you lose, right? People want to know, well, can I get in at the right time so that if it's not going to work, I just never got in the first place? When is that place? When is that entry? Because that's when I really want to get in. After I know for sure the trade is absolutely going to work, then I'll get in. When is that? After it hits the line, before it hits the line? So we'll get into it Friday, but when uh when we get a breakout into the 111, like the millions of pictures that I've got bogging up a hard drive, I don't like to short from the hole. So if price ran up and hit the 111 and then turned around and start falling, I don't sit there and wait for it to break 100 and then get in. Why? Because it's already falling. I never want to do that with options, by the way. I might do it with futures, depending on if it's a new candle and it pulled back within that candle where I could possibly grab it on a pullback. But never will I grab a put after it hit 111 and fell all the way down to one and then fell through the one. And then I'm going to buy a put. Never. I buy puts when price is still green. I don't buy puts now that price turned red and fell for X amount of points and then get in. Uh-uh. I've got a whole file of these 111 reversals. This is how I study new trade strategies and new trade tactics. I go back and I find old examples of the trade. Doesn't matter if I actually traded it or not. I find examples of what I want to trade and I gather as many examples as I can find and then I start to study them. And what we're going to go through Friday is how would we have traded this? Does waiting get you anywhere? Look at that one, right? We rejected, we came right back down, we broke 100. Hey, it finally broke 100. We should get in. Nope, that didn't work. We went right back up again. Now, it's not to say that you can't do it. That's futures, right? That's not options. It's a viable play, but why wait? Right? What are you waiting for? Confirmation? Where does your stop go when you wait for confirmation? There's all these things we're going to get into on Friday, right? And it's not right or wrong. It's just there's only like five choices. These are the choices that you have, and you have to choose which one of those you like the best. And unfortunately, it's not going to improve your win rate or your success rate because making the choice to get in has no bearing on the fact that you thought we were going to go up or you thought we were going to go down and you were completely wrong, right? That's what it comes down to. Was the trade a long and I went short? Was the trade a short and I went long? It doesn't matter if you wait until we get through the 100 or not. If you're wrong, that trade's going to lose no matter what, right? And that's the sneaky part about any of the fibs. VWAP, moving average, ADR, open high low close, floor pivot, 111. It doesn't matter, right? All of them. So getting in isn't the problem. It's is that actually a reversal or not? But we'll go through it on Friday. This file is also something we're going to go through on Friday. Now, this is my file and it's from one of my trades. This is the 111, right? All of these pictures are for the 111 and they're for about 2 months of price action. That's all. I didn't even go back for very long, just like from July, August, and a little bit of September, I think, right? So that you want to find an example of the trade that you want to take. What does it look like? Where does it happen? How often does it happen? How much price can you normally get out of it? That's the kind of work I do to figure out if it's a trade that I even want to focus on. And you can do this sort of research for any trade: moving average bounce, open high low close, VWAP, whatever it is. If you go back and find 30 different examples, now you have something to study. Some that worked, some that didn't, some that bounced really early in the day or really late in the day, or it was an economic event kind of day. The more you understand about the trade that you're about to take, the better you can recognize when something is going wrong. Like, hey, it's not supposed to do that. That thing is misbehaving. I'm getting the hell out of here. You don't even have to wait for it to hit your stop because it's not behaving the way it's supposed to. You just get out. If I always ask this question, if you don't know what the trade looks like, how are you supposed to trade it? And it's a sneaky question because, well, a lot of people don't realize that their trades are supposed to look a particular way. So we'll get into it Friday. And hopefully by the end of Friday, you guys will have this research tactic that you'll be able to employ going forward to research new strategies like MACDs or stochastics. It really doesn't matter what it is, right? Anything that you want to trade, this research tactic will work for that. And it doesn't cost money like those back trade services where you can buy these expensive platforms and do back testing, but I will argue that this is just as good and it's free. And I like free. Free's a big fan of mine. So I'll see you guys Friday. If you have topics you want to hit, let me know. If there's a way to clean up this request or add to it, let me know. I'll gladly dial in on any part of this, right? Just send me a DM or just at me in the chat. I'll get it added to this for Friday, and we'll focus on that. Cool, cool. That's what I got, guys. It's time to go eat.